It's another week of Business Morning. Good morning and welcome to the program. I'm Chimeze Obi Iwago. We start off the show from the global oil market space as prices slumped by more than 2% this morning as surging cases of the Omicron coronavirus variant in Europe and the United States stoked investor worries that new restrictions on businesses to combat its spread may hit fuel demand. Brent crude futures fell $1.92 to $71.60 a barrel, while U.S. West Texas Intermediate crude futures fell $2.09 to $68.77 a barrel. The Netherlands went into lockdown on Sunday, and the possibility of more COVID-19 restrictions being imposed ahead of the Christmas and New Year holidays loomed over several European countries. U.S. health officials urged Americans on Sunday to get booster shots, wear masks, and be careful if they travel over the winter holidays. Meanwhile, U.S. energy firms this week added oil and natural gas rigs for a second week in a row. And back here, as the Christmas season fast approaches, Nigerians are still lamenting the rising cost of cooking gas in the country as they seek alternatives such as charcoal and firewood. Over the last 3 months, the price of cooking gas has risen by over 100%. In the next report, our correspondent Emperor Simon examines how Nigerians are coping with the rising cost of gas.
Sylvia Okeme is a restaurant owner in Abuja. Before now, she used a 12-kilogram gas cylinder to cook. However, the rising cost of cooking gas has forced her to seek an alternative, which has its impact on her business.
It's not been well since the gas added price. So for now, we haven't been able to buy gas again. We are using firewood and charcoal. But it's only the small one we normally refill here to warm up the soup.
Like Sylvia, Abigail Emmanuel now uses charcoal as she can no longer afford a cooking gas.
So many people do not have money to buy gas and kerosene. That's why most of the people start using firewood and charcoal.
These are not the only ones feeling the heat of the hike in price of cooking gas. Nigerians on the street share the same sentiments.
We were encouraged to buy gas and be using gas. The price was very, very low. And now people have come to use gas and see how the price have skyrocketed.
In terms of electric, like people that use electric stove, the electric is not, the light is not even stable. So you cannot be proud of it.
According to the National Bureau of Statistics, the average price of refilling a 5-kilogram cylinder for liquefied petroleum gas in Nigeria increased by 9.61% month-on-month and by 34.51% year-on-year to 2,627 naira 94 kobo in October from 2,397 naira 60 kobo in September 2021 and 1,953 naira 71 kobo in October 2020. However, that statistics may have changed as our findings within the Federal Capital Territory shows a kilogram of cooking gas now goes for between 750 naira and 800 naira. The cost of refilling a 12.5 kilogram cylinder is now 9,000 naira. 10 kilogram is around 8,000 naira. 5 kilogram is 4,000 naira and a 3 kilogram cylinder is refilled for 2,500 naira. For many Nigerians, the use of cooking gas is something that they have come to like. But now that the cost of the product is rising every day, they are left with no option than to go back to alternatives they left long ago. While Nigerians continue to deal with the current reality, it appears the federal government has little to do to change the situation, as explained by the Minister of State for Petroleum Resources, Mr. Temipre Silva, during a recent press briefing at the State House, Abuja. However, he explains that the president is concerned about the situation.
We must understand that cooking gas is not subsidized. It is already a deregulated commodity. So the price of cooking gas is not determined by government or by anybody here in the industry. And we are quite concerned. Mr. President also is very concerned. He's aware that the price of gas is high in the market, and we are doing everything to see how we can bring down the price of gas, especially as we approach the Yuletide.
Stakeholders, however, proffer some solutions.
So competition and increased number of players would bring down the price. So in the short term, we need to reduce the exports and bring those volumes in country. That would have a significant impact.
We need to free up more domestic molecules. How do we free up these molecules? Is by reducing exports of LPG out of this country. We have to find ways to domesticate the supply side, to improve supply side by domesticating the products that are exported into Nigeria.
It's not certain how long the hike in the cost of cooking gas will persist. What's certain is that Nigerians are not finding it easy under the current price regime. Emperor Simon, Channels Television News.
And to our main conversation for today, Nigeria's central bank says banks recorded 1.3 trillion naira non-performing loans as of November 2021, with non-performing loan ratio printing at 5.4%. That's above the CBN's regulatory requirement of 5%. On capital adequacy, CAR for the banking industry remains above 15%, which shows sustained resilience of the banking system. On the program today, of course, we begin our countdown to the end of the year with a review of some developments in the economic space. Our focus on the show today now is the non-performing loans in the banking system and how it can be minimized going into the new year. And joining me to discuss this is a financial and management consultant and the CEO of Flame Academy and Consulting, Mr. Oji Udemezue. Good morning, Mr. Udemezue, all the way from Nairobi. Good morning.
Yeah, well, it's afternoon here from Nairobi, and I'm very happy to join you in this program. Well, good morning to you in Nigeria. Good afternoon, Nairobi.
Great. Well, non-performing loans has been consistently above the prudential benchmark of 5% for some months now. What's your view?
All right. I think looking at the historical trend, you can actually say that it's getting better now. If you recall, sometime in 2016, when Nigeria went into a deep recession, economic recession, before the COVID-induced recession just came upon us, the banking industry got to a point where non-performing loans climbed to almost 15%, triple what the regulatory benchmark should be. And in fact, some banks individually hit as high as 25–30% non-performing loan. Mind you, this is the total volume of loans that have challenges. You know, loans being contract agreements, they have particular patterns in which they are meant to be repaid. So whenever repayment ceases to follow the pattern, the loan is said to be delinquent or non-performing. And all the aggregate amount of non-performing loans, divided over the total loan book gives you a ratio. And because in banking, there is very small room for error. Looking at the fact that banks are highly leveraged in their business model, where they use maybe, let's say, about 100 million money provided by the owner, that's capital, they can lend as much as 1 trillion, leveraging on deposit bought by customers. Whereby, if even just 10% of the loan book goes bad and is provided for, you'll find that the bank's capital will be wiped off, license withdrawn. So the regulatory minimum is 5%. That is, banks must not have an NPL ratio above 5%. Otherwise, there will be danger in the industry. But looking at the trend from 2016, it has been coming down. Sometime 2 years ago, it was about 9%. Then it came down further to about 6.4 last year. But COVID came upon us in 2020. And COVID is meant to impact the economy negatively, with several businesses struggling to pay their loans. So to see in the midst of COVID, the NPL trending downwards from about 6.4 June 2020 to about 5.7 in June 2021 is a good development. So I must commend the central bank and of course the bank's executive management for this effort. Even though I must remark that there's also some danger awaiting the industry because of the central bank's forbearance arrangement, proactive forbearance for banks to give more room for customers to pay their loan based on COVID issues. We have a lot of will I say, clients in the industry who are in coma, but they are administered, a coma to enable the economic recovery before they can pay. The banks have to be very proactive in ensuring that these COVID-induced bank loan delinquency are resolved. Otherwise, Chimeze, you will come up again maybe in the next 1 or 2 years to come and discuss how the bettering NPL ratio may begin to worsen again. So now, it depends on actions taken by banks from now on, and we can discuss that.
Yeah, Mr. Demese, first of all, let's look at some of the sectors, that probably may have been contributing to this rise in NPL, maybe in the past or perhaps in the future, just as you have mentioned. What are these sectors that you think are likely to pose a danger for the banking sector?
One of the major sectors that have thrown banks into very big shock and very big trouble, where they've had to do very huge provisioning, is the oil and gas sector. That's a major, one of the most viable sectors of the economy, even though that sector contributes less than 10% of our GDP. But you find that because the transactions there are very sweet and very lucrative, big ticket transactions where banks can close deals and also have a lot of foreign exchange coming in. Banks tend to over-leverage themselves, overplay their hands in that sector whenever the going is good. And you find that whenever the oil price is nice and very bullish, that sector is doing well. Tank farms are springing up here and there. Oil exploration is going on very well. Oil servicing, and this sector demands high capital to operate. So you find banks lending extensively there. And once there's a shock there, like we had in 2016, and even though the OPEC Plus has tried to manage the law, a bearish trend in prices, and that's why that sector is not doing so badly right now. But oil sector has contributed largely to banks' undoing in terms of non-performing loans. And again, looking back in the past when we had to do the hard behavior, whenever a sector tends to improve, banks tend to move there in a hard manner. Before 2008, 2009 financial crisis, banks had also got exposed heavily in the margin loan, giving loans for stock trading, and that also exposed them. That is not managing concentration risk very effectively. And of course, the manufacturing sector is a very large part of the Nigerian economy. And while banks are very scared and careful in lending to this SME in Nigeria, there are some companies that also have good big loans in that sector. So the manufacturing sector is another sector that many times throws banks into a big shock, because once the economy is not doing well, the manufacturing sector also begins to dwindle in prosperity, and you find them struggling to pay back their loans. From manufacturing to cement to pharmaceutical, and of course, a few service industries are, players are also contributors. But the key contributors here usually are oil and gas, manufacturing, and the occasional time when we went into margin lending, in defiance to risk management framework that banks should have. So if we have time, we can discuss what can be done to strengthen the situation. And let me also remark, in commending the central bank, that part of the reason why we have seen the NPL ratio abating or getting better is because of also the global standing instruction now introduced in the industry, whereby banks are now authorized to set off balances of customers, particularly those chronic debtors who will owe a bank and refuse to pay, while running balances, positive balances in other banks. Today, banks are having the power to now annex or take over such balances to settle debt. And this is a very big solution to chronic debt situation in Nigeria. And of course, the credit bureau system is also getting better. And of course, mind you, in a country where you don't have a strong credit bureau system, people will play the system. They borrow here, play games, and go to the other place and borrow. But once you have a very good credit bureau system where these people are exposed, then that resolves the problem. So this thing has helped already.
Yeah. All right, Mr. Demese, you did mention about you are a risk expert, and you did mention about the risks that the banks would have to watch out for, particularly as it concerns the forbearance that, was granted and all of that. So Can you tell us, how do you think going into the new year that the banks will begin to, look at this and be able to manage some of these risks that are unforeseen, if I would put it that way?
Now, credit risk is so critical in banking. Most banks make a whole lot of their profit or revenue from the credit portfolio. And that's also where most of their risk comes from. And whenever an economy is not doing well, many businesses are struggling and their loans are likely to go bad. And once they cannot meet up with payment plan and arrangement, you begin to get them classified as non-performing. So one, banks from the board, I must state this because many times the key issues come from the way a bank is governed. Governance and risk management is very critical in this matter. Credit risk is one of the 4 major risks that can bring a bank down: market risk, credit risk, liquidity risk, and operational risk. And when credit risk is joined with operational risk, where staff or management or executives are not behaving well, a bank can fall overnight, no matter how big that bank is or how long it has run. So my advice is, one, banks must ensure they are properly run. Bank owners and shareholders or directors must not overplay their hands. They must not abuse the system. Insider abuse has been reported severally by central bank's audit, where several co-owners, directors of banks, owe the bank that they manage and they refuse to pay the same loan or take unnecessary big risk because they think that the money is free for them to use. And then the bank begins to struggle. And central banks in recent times have always frowned on such banks. Even a too big to fail bank, or what you call domestic systemically important bank, had recently failed or polarized, even after acquiring another bank in just 1 year. That's the nature of what insider abuse can do to a bank. Then very importantly too, banks must take time to properly train and groom their people in their credit process in line with their standard credit policy, what you call a credit policy guide. Any bank that must survive credit risk must have a clear procedure. Approval processes must be streamlined. How loans are documented and secured, security perfection, and very importantly, capacity building not just in the hands of remedial managers, but people who are in the front line. But in the 3-tier process of risk management, that's the 3 lines of defense model, the owners of the risk are the people who book these loans. They are, most times, I'm a trainer, and we train several banks in Africa. I'm doing that in Kenya right now. You find that many banks don't spend enough time to train their staff. And people don't know what to do when loans begin to get delinquent. And over time, and you find that there's a correlation, a positive correlation between capacity building and quality risk management. A number of banks in Nigeria are still below 5%. I can tell you that, but I'm not calling names. Some banks are doing 2%, 3% within the limit, while a whole others are doing 19%. Even in the midst of 6.5% we have now, I can tell you for free that some banks are somewhere around 15, 17%, which is very bad. And you find those banks not spending enough time and resources to prepare their people for the loan recovery or remedial or workout process. It's technical and also, soft in a way. So it's important that as we come into the new year, banks must sit back and proactively look at all the loans that have been affected by COVID. Yes, even though they have proactive forbearance allowed by CBN, very soon that period of forbearance will lapse, and those loans might begin to get classified as delinquent. And this figure we are enjoying today will get worse and not better. While we expect the limit to come between 5%, we may actually get worse in the next 1 or 2 years if banks don't do what they need to do in terms of credit risk governance and management.
We hope that doesn't get to that. Thank you very much, Mr. Udemezue, for sharing your thoughts there. It's always a pleasure.
Always my pleasure to join you, Chimezia. Thank you so much.
As with most other years, 2021 brought fascinating developments in the financial markets, especially as the path from the pandemic was far from certain. However, some analysts say the performance of the financial markets generally fell in line with expectation as fiscal and monetary stimulus packages resulted in a pull to none. Let's bring in Tajuddin Ibrahim now, the Director of Research and Strategy at Chapel Hill, Durham, to talk to us more about the market in the year. Good morning, Mr. Ibrahim. Thank you very much for joining us on the program.
Good morning, and thank you for having me.
Well, the strong start to the year in the equities market was kind of derailed by the upward retracement in fixed income yields before impressive corporate earnings lifted market performance in the third quarter of the year. How would you describe the performance of both markets this year, and what were the major drivers?
Well, I think the major development in the fixed income market, for instance, is a case of repricing of fixed income assets in that market in the third quarter and also subsequently in the fourth quarter of this year. We noticed that yields were elevated in the second quarter, largely speaking, because we had a bit of aggressiveness on the supply of bonds to the market. But when we began to see a slowdown on both the bond and also the T-bills market, interest rates or yields on those instruments began to drop, and equities, now became sort of more attractive to investors. We also bear in mind, some sort of corporate announcements that underpinned the performance of the equities market in the, third and fourth quarter of this year. We bear in mind also the strong earnings delivered by companies and sectors in the equities market. So these factors were responsible for, the positive gain that we have seen so far this year in the equities market, for instance. But we bear in mind also that yields in the fixed income and money market spaces are still, somewhat, below, levels that we saw in the second quarter. To be specific, 1 year T-bills, for instance, cleared at 5% discount rate in the last, primary auction for last week. That is a very cheap source of, borrowing for the government, in my view. So the two markets have not really performed badly this year. It is just that inflation has been, somewhat stubborn despite falling. But we like the fact that economic recovery has been, broadly speaking, positive and steady in year 2021 so far.
Now, 2022 being a pre-election year, how do you see the sensitivity of markets to events in the political landscape?
Well, I think for 2022, a market sensitivity to political development, I think naturally speaking in this country, you would see enormous volatility in the market when we have, election coming up, largely speaking in pre-election years. But those years have, passed, and those were years that the market was, largely controlled by foreign investors. Foreign investors naturally, when we are about a year to election, would leave the Nigerian market and, look for, safer markets, either in the developed market or in the emerging market. But, this time we have a different development because most of the foreign investors in the market have exited, and we have, mostly speaking, the local investors. And we would expect that the local investors, would not, shun the market because of pre-election. And what we even expect is increased participation in the market because we have the locals playing the market as we speak. We are all in this market. We are going nowhere. We have no other country to go to. We have no other markets to invest in other than this market of ours. So my expectation is that the election next, the pre-election year, being 2022, will not be a damaging one for the stock market and the capital market as a whole, in my view.
Okay, now, I like that hope that you have portrayed that optimism. But then I think sometime last week, the Securities and Exchange Commission came up with an announcement about transaction fees or increasing the transaction fees, fixed income market starting from January. And looking at that, a lot of people would think that would actually discourage, some potential investors, local investors, as you may call them, from getting into the market or even investing, because that is going to impact the return to their investment. What do you think?
Well, I think the impact on returns, let me start with that, would not be material because the fees they are looking to charge is, below, a level that could negatively impact, returns in that market. That is one. The second thing I think for everyone to bear in mind is that, this development is in line with regulation. It is in line with the rules and regulation, of the Securities and Exchange Commission. So, the market, in my view, should welcome it and, look for ways to improve, on the yields on their portfolio and accommodate, this new charge that the SEC has brought forward. My view is that, institutional investors are, largely speaking, the players in the money market and also in the bond market. So, retail investors are not, that much in terms of, their impact. So what I expect is for the institutions to take this fees and, look for other ways to improve on the returns on their portfolio. We bear in mind that the government needs more revenue to finance the budget. And this looks to me like one of the ways that the SEC wants to rake in higher revenue in 2022. In my view, it is in line and consistent.
So, in other words, we are likely to see kind of periodic portfolio rebalancing, in the coming year.
So if they were to rebalance their portfolios, where would they go to? So that was the first question. And, the beneficiary in that case would then be the equities market. And one thing that I know for sure is that, portfolio investors, mostly speaking, the pension fund administrators, are not really playing much in the equities market. They are not up to the, required limit by the regulator. So most of them will still leave their funds in the fixed income space, irrespective of, the newly introduced fee by the SEC. So they will take it, in my view, and if they have to move a bit, it will be to equities, and I do not expect an aggressive move to equities because of that.
Okay. Now, Nigeria was able to tap the Eurobond market for capital in 2021. What should we expect in 2022?
For money markets?
Yeah.
Yes, okay. For money market, I think what investors, should expect is, a repricing of yields in that space in 2022. I just said earlier on that it is looking likely that we close 2021 with the discount rate on one-year Treasury bills being around, 5% or, a bit lower than that. That number is materially below inflation, which is 15.4%. That means negative real return for investors in that case. That number also is below, the monetary policy rate, which is 11.5%. So my sense is that, next year, we'll probably see in what we call normalization of monetary policy by the CBN. And if that materializes, investors should expect higher yield on Treasury bills in 2022, and it will be a market for most investors to play in. But I sense that there will be issuances of commercial papers in 2022 before we see a repricing of yields, as corporates would like to take advantage of the low money market rates to issue commercial papers and support their own liquidity position, in my view.
Okay, so given your expectations of yield elevation in the fixed income market and probably a heated political climate that characterizes a pre-election year, how do you see that impacting the equities market?
Okay, so for equities, I think my view around equities is that we most likely are going to see investors, try to purchase higher yield, higher dividend stocks. As we speak, we have, some listed equities or stocks that have more compelling dividend yields than what you can get on one-year Treasury bills. For one-year Treasury bills, you will get around 5% as yield. But if you are buying Zenith, if you are buying Access Bank, if you are buying GTCO, if you are also buying some, high conviction names like Dangote Cement, MTN, most likely the dividend yield you will get will be well above what you would get in the Treasury bill space, the money market space. So I expect investors in the first quarter of next year to shift to those names because of the compelling dividend yields in that space. So that's my expectation. I believe they will earn more for their portfolios if they diversify accordingly, away from money market and move more into high dividend yield stocks for the first quarter of 2022.
All right, thank you very much, Tajuddin Ibrahim, for being with us on the program this morning. We do appreciate your time.
Thank you for having me.
Okay, let's now do an opening call to the market. And of course, we have our dear Anyete Edit there. Well, Anyete, the equities, of course, saw a positive outcome last week. I don't know if that will continue. This is the week of Christmas. I don't know if the Santa Claus, we always expect Santa Claus in the market. Is it coming this week? I don't know. But first, let's kickstart the conversation with the activities at the FX market. It's always interesting to know how the Naira is moving. So what happened at that market yesterday?
Well, good morning, Chimi. For the Naira didn't do too well. It was down by 0.01%, but I'll go to that much later. Let me bring you, up to speed with what happened at the market last week, the Forex market. The transactions there was mostly positive, but then the total volume of transactions was down by 41.92% week on week. That's against the other week. It was down by this amount there. And that, of course, comes amidst the CBN's continued support for the Naira. And then, of course, we didn't have much transactions coming in. We will be having Forex and fixed income market analyst Choma Udu to tell us more about what happened at that market. Now, over to where you talked about the volume of transactions there. The value was down by more than 6.47%. Of course, that's for last week. We'll be looking out for how it turns out this week for the market. Of course, it also comes as the Nigeria's Forex reserves, it still remains under pressure. It fell by $181.19 million as at last week. That's as at December the 15th. And of course, the Naira was flat. At the Nigeria Autonomous Forex window there, it was down by 0.01%. And of course, at the INE window, it was up by 0.3%. And then at the parallel market, it was down. It was up by 11.7%. Now, let's go over to the fixed income market there. It was mixed, but at the same time was with a bullish bias there. Of course, we had investors continue to cherry pick on some instruments across the curve. At the average yield declined there by 2 basis points, but most of the attention was focused on the 18th of April 2037 paper, which has a value of 7.62 billion naira, deals there 6 and a price high of 121.78. In all, the value there was 12.17 billion naira. Over to the Treasury bills market, not much of activity there, but it was still a bullish activity there. We also had quite a number of activities at the Treasury bills market. We had a primary market auction, of course. Average yield for the primary markets auction, we had there was an 11.5% oversubscription there, and the auction closed with the CBN allotting more than 960 million naira worth of 91 days, 1.1 billion naira worth of 182 days to maturity, and then 3.80 billion naira of the 364 day to maturity paper at respective stop rates of 2.49%, 3.45%, and 5% against the previous level at which it was. Of course, for that market, for both markets, where traders are expecting that at the bonds market, the yields there will oscillate around current levels, driven by thin maturities and deliberate effort by the Debt Management Office to reduce domestic borrowing and the domestic borrowing costs for government. And then they also expect that non-bank liquidity will be geared towards relatively higher non-sovereign instruments, so thus tempering demand. So now to give us more highlights of what happened last week and then what to expect this week, let's talk to Chioma Udu, a fixed income market dealer at GT Bank. Thank you for joining us, Chioma.
Thank you for having me. Good morning.
Okay, so the market had quite a number of activity. I'm just a journalist. You're the trader. So can you give us more information about what happened last week and then what to expect, of course, when we had the inflation numbers coming in and lowering? So what impact is that expected to have on investors?
Okay, I'll start from the money market. On Friday, there was a bond auction settlement of about 100 billion, and then there was a promissory note maturity of about 30 billion, which came into the market. So that helped shut the effect of the 100 billion leaving the system. Barring any funding activities that for Friday, we traded at about 7 to 10%. We expect the market to be up about 100 billion coming into today. Barring any major funding needs, we expect the market to trade at the range of 10 to 12%. For the T-bills, the secondary market traded on a quiet note, with the NCD trading slightly above 5% on the long end of the curve, of the T-bill curve. We saw more demand on the special bills and OMO bills as they are offered higher than the NCD, currently trading at about 5.9%. And we expect funding to come in tomorrow from the OMO maturity of about 45 billion. And then we expect some bargain buys because of liquidity we expect to come into the market on the special bills and the OMO market. And when we go to the bond space, market is quiet. The focus now is on the Sukuk. 250 billion is on offer on the 10-year bond maturing in December 2031. The rental rate is 12.8%, and we think it will be oversubscribed. We expect fact to come into the system and some liquidity to come into the system. Well, the Sukuk bond is trading is going to close higher, and we expect that there's so much interest in that space as the benchmark bond of 2029 is currently trading at 12.5. So it's higher yield in Sukuk, so we see a lot of interest in that space.
Okay, so thank you for that piece of information at the fixed income market, and we'll be looking out for how the market turns out in the start of the week of this week, the fourth trading week of December. Okay, so now before I go to the equities market, let me give you some information about the central bank's special bills. Just 4 deals carried out there, and I think just before I go, this is how the market turned out last week. 260 billion naira gained, 112.1.12 and 1.16% on the equities market index and the market capitalization. So green and red, the color of Christmas. Let's see if that's what is going to turn out. And of course, if maybe there's going to be a Santa rally, keep our eyes out for that.
I'm for the green, Anita. I'm for the green.
Well, what
Santa
could be good for you? What
rally,
could be good for you could be not too good for someone else.
Oh, well, I always like to remain positive. Okay, thank you, Anita. We take another quick break. When we come back, we look at the cryptocurrency market. Just stay with us. Okay, it's now time to talk about crypto. And here is Ladi. Ladi, I see a lot of fear out there. Omicron,
inflation fears, everything all wrapped in one. And traders are very scared right now. Imagine losing Bitcoin, losing that 50K range. And now the dreaded death cross has actually happened just a few days ago. So traders are really scared right now. And it's a complete red in the market. Just the stable coins there in the green, and surprisingly, XRP in the green too. Bitcoin now just staying steady there, the 46,000 range. Could go lower with the way it's looking. Fear greed index there. You see it's extreme fear right now at 25 points. Just a few months ago, we're at extreme greed just here. But you know how this market swings? It swings back and forth between fear and greed. Market cap, $2.17 trillion is down 2.50%. 24-hour volume traded in the total crypto market, $81.13 billion. And we see Bitcoin dominant. It's been ranging between 39% and 43%. This morning it's 40.52. The price of Bitcoin, $46,373. Bitcoin is still holding strong there. It could get to the 48,500 resistance. It's been ranging between these levels for some weeks now. And now the bears seem to be in control of the price, but some still believe that the bulls might actually take over at some point and take this price up. But you know how this market goes. Some buy in fear, some buy in extreme greed. 24-hour volume, $27.70 billion traded in Bitcoin. And we see Ethereum there losing that $4,000 mark. It's down 3.88%. Still looking towards the 3,500 range for the next support there. But price of Ethereum right now is still below 4K. 24-hour volume traded in Ethereum, $17.42 billion. And top odds by market cap there, we see BNB there, $519. It's lost that $600 mark. It's held that for a while now, down 3.72%. And we see Cardano had an incredible run this year, though, but it's at $1.22, still holding that dollar mark as we speak, but it's down 5% this morning. And we see Solana there losing the $200 mark. It's down 6%. And XRP there, 86 cents, is down about 4%. Still have my eyes on XRP. I feel XRP can do something at some point, maybe before the end of this year. But let's bring in Olumide Additional, our financial market analyst. Great to have you, Olumide. Good morning. Hello, Lumde.
Yeah, good morning, Ladi. Good morning.
Yeah, happy Red Monday. We've been saying this a lot to each other. I don't know if you recall. Anyway, we see Bitcoin seems to be skating on thin ice right now. We had the talk about the dreaded death cross that took Bitcoin to about 28,000 the last time. It's about to happen again. Could have happened. What are you seeing?
Yeah, I think, well, for bookmakers, the odds are increasing, getting stronger, because you need to understand that the dollar is gaining momentum, and the Omicron virus hitting Europe and United States at unprecedented level has caused some form of panic in risky assets. We're seeing crude oil down more than 3,000 basis points. We're seeing U.S. stocks also down. So it's not a new narrative in the crypto market. And you need to understand that the crypto market is more riskier than all these other asset classes. So we are seeing drawdowns. And right now, Bitcoin is fighting several battles of staying after the $45,000 mark. That remains to be seen if that will happen in the next couple of days. But just like you mentioned earlier, the death cross, the long FEC death cross, where the 20 exponential moving average moves below the 200-day moving exponential average. It just tells you that the odds are increasingly getting stronger, that it's very likely that Bitcoin might touch below 40,000 before the end of the year. But the narrative is still strong. We're seeing that some altcoins, like you mentioned earlier, XRP, gaining strength. We see sellers, we see other altcoins telling you that it seems that some altcoins are distorting from the bearish sentiment. But I think, like you rightly said, it's a red Monday right now.
Yeah, and looking at some of those play-to-earn tokens that are making the rounds, they're losing the trend right now because the prices have been knocked off. Meme coins aren't doing well, even though we saw Tesla announce they would accept Doge for payments. What's happening in that?
Yeah, I think the narrative about meme coins is that investors need to understand that because of their inflationary properties, it's very difficult for value to be sustained. You know, Dogecoin, for example, has unlimited supply, and the fact that we've seen most tweeting less about it, if you look at the relativity of 3 months, it suggests to tell you that there is no trigger that's pushing it, despite the fact that there are rumors that Tesla might soon accept Dogecoin for payment. But it's yet to be seen if that sustainability can be exhibited, and that is why we've seen Dogecoin, for example, moving away from the top 10 most valuable crypto assets and breaking up from its record high at almost 80 cents, now trading below 20 cents. So the narrative is simple, that inflationary assets exposed in the crypto market will suffer when the bearish sentiments come to play.
All right, and I see MicroStrategy was in the news again. They were talking about lending their Bitcoin to generate yield. What's that about?
Yeah, I think it's just a form of strategy to earn more bucks on their exposure. Don't forget that this is the company, this is one of the few companies that listed public American company that has so much exposure in Bitcoin. And you need to understand that right now the price of Bitcoin suggests that it's much more advisable for them to start looking at innovative ways of earning revenue. But I think the truth about the matter is that that left to be seen if that's going to be a profitable venture, because right now we're seeing that investors were betting on MicroStrategy stock because of the exposure to Bitcoin. And if you look at year to date, that's already gained 183% already. But you see, the narrative is that Bitcoin being a very volatile asset compared to other risk assets might bring in more downside. So despite the form of trying to bring in much revenue with that, I don't see much changing.
All right, Lumide, let's play a little game now. I'm going to mention 3 cryptocurrencies: Ethereum, Shiba Inu, and ZRX. You have to buy one, sell one, and hold one. What are you doing?
Yeah, I think definitely I would hold Ethereum. Definitely, Ethereum has a very new use case. We're seeing that it's really capturing the NFT space. Just recently, FTX announced that they'll be introducing NFT-based on Ethereum network. That just tells you the upside around Ethereum. Well, I'm not a fan of meme coins, but the fact that Shiba Inu had some form of these bonds, about 40% of their supply, and we saw that most investors in that side made a lot of money. It would be very wrong for me to put it on a sell position, but I think I'll be neutral, and I think on the later I'll place a sell on that.
I guess you're changing the game, Olumide. Anyway, thank you so much, Olumide.
Yeah, thanks, Ladi.
All right, now let's look at the top gainers that we see. Remain 1 cent. It's up about 19.71%. It's the only double-digit gain we have this morning. And we see Yield Finance there, $32,807, up 5.79%. We see Celsius there, $3.97, up 5%. And we see XRP, 86 cents, up of 4.01%. They still have that case with the SEC there. There's no consensus yet at the moment. And we see OKB, $33, up 3.99% there. Look at the top 5 losers there. We see Cadena there, $10.16, down 10%. And Internet Computer, ICP, $21. This one has not regained much ground ever since it came out. It came out about $700. It's now trading at $21. for a while now, but let's see if it's going to gain something before the end of the year. It's down 9% this morning, and we see waves there, $15 down 9%, and we see Mana there, one of the metaverse tokens there, having that pullback, $3.15. It's down also 9.26%, and they have Curve there, $4.02, down 9.21%. So, Chimmy, it's a very scary market, so it all depends on risk appetite right now.
I see. Well, I would ask, irrespective of the fear in the market, is there a possibility that maybe that market could welcome Santa Claus this week?
A Santa Claus rally. This market, you cannot determine this market.
You said earlier you have your eyes on XRP.
Yes,
I have my eyes on SHIB.
SHIB, yeah. SHIB, the people's coin.
Absolutely.
Everybody loves Shiba Inu.
Well, I just hope that coin would eke out some, gains before Christmas.
Yes.
Let's perhaps get some kind of gift from Santa on that coin.
Yeah.
Okay. Well, that's not a financial
Fingers
advice.
crossed.
Anyway, so you seek financial experts' advice before you
Very
actually
important.
play
Don't take our
in
word
this
for it.
market. All right, thank you, Ladi.
Thank you.
Well, that's a wrap on the program. Don't forget to join us by 1:30 this afternoon on Business Incorporated for more updates on developments in the world of business. I'm Chief.